Right. Hello, everybody. Thanks very much for joining us. If you haven't met me before, I'm Helen Bradley. I work for Future Assets and we run the Growing Future Assets investment competition. I'm delighted to be joined by Sajir Ahmed, who is an investment manager at Aegon Asset Management in Edinburgh. And he went to school in Edinburgh as well. So he's Edinburgh born and bred. So he can tell us about what it's like to, he's going to tell us about annual reports and the types of information you can find. But if you've got any questions at the end about what it's like to be an investment manager, what kind of things you do, what kind of skills you need, then by all means, you can ask Sajir those questions. What I'm going to do, I will be here, I will have the chat is open and the Q&A is open. So if you've got any questions at all, you can pop them in the chat and we will ask Sajir at the end. Or if you're really feeling brave, you can ask the question yourself. So with no further ado, I will hand over to Sajir.
Thanks, Helen. Hi, everyone. Good to see so many people online, and hello to everyone who's watching the recording as well. As Helen said, my name is Sajir. I work for Aegon Asset Management as an investment manager. Aegon is a large insurance and pension company. We help people save for their financial goals, and typically retirement tends to be a really big goal that people save for over the course of their life. To that end, we tend to invest quite a lot of our clients' money in different asset classes. So the asset class I work on is equities in the stock market. So we buy and sell shares in companies that we think will grow value. So everyone wants to buy the next Google or the next Amazon. If you do that, your client's wealth grows and they can have a nice retirement, and your career benefits as a result as well. So my job is to analyze various companies that are listed in the stock market to understand what's their business model, how do they make money, what are the competitive opportunities and threats facing them, and how they'll grow their business to become a good investment for our clients. And a key tool in doing my job is using companies' annual reports. So by law, all companies above a certain size, and every company in the stock market, has to publish an annual report telling investors how they've done over the course of that year. And that contains some very, very helpful information that will be essential to you guys as part of the Future Asset competition to gain information about the companies you guys are looking at. Prior to working at Aegon, I used to work at a large accountancy firm called PwC, where I helped companies to make those annual reports. So I've got a little bit of insight that I can hopefully share with you guys. So I'll talk you through the key sort of bits of information that you can extract from an annual report, as well as the areas to sort of watch out for. So what I'm going to do is I'm going to share my screen and I will talk you through an annual report. I think that's probably the best way, rather than me talking without any sort of aid. So the company that I'm going to use as an example is a company that I'm sure all of you have heard of and indeed been customers of, is Tesco. So Tesco is a supermarket amongst other sort of businesses, and if we have a look at their annual report, we can hopefully try and answer a lot of those questions about what the key bits of information are and what are the things to watch out for. So the first thing I'll draw your attention to here is the contents page. It's split into three sections. There's a strategic report. This basically tells you what the business is doing right now, where the business is coming from, what their growth plans are. This is very wordy. You'll get a very good understanding of what the business does, what its competitive environment is, what are their growth opportunities if you read the strategic report. The second section is corporate governance. This is about how the business is being run. So who's on the board of directors, how much of the leadership team being paid, how is the leadership team being incentivized, what are the responsibilities and duties of the board of directors in running Tesco. And the third bit is financial statements. So this is the actual numbers. So, you can have a lot of words up here in the strategic report about how fantastic we've been and how great we are. But ultimately, it comes down to the financial statements. They tell you how much revenue they've made, what their costs were, what the profit generated by the business is. And you guys will be looking at the financial statements to extract some key information around revenue, profit margins, etc. And I'll talk you through those as well. So one thing you'll notice immediately is this is a very, very big document. There's 214 pages, and I personally do not read all 214, and I'm sure the expectation for you guys is not to go through and read all the pages in the annual report. There's just way too much information in there, and not all of it is very helpful. So what are the key bits of information that you want to look at? I think one of the key bits of information is the sort of introduction, what they're calling Tesco at a glance page. Most companies will have this, and this is really helpful if you want to understand what a company does. So if you look at Tesco here, this is telling you straight away that Tesco is a British grocery retailer, and you get a sense straight away that it's not just in Britain, but they also have geographies in Europe. So they've got stores in the Czech Republic, Slovakia, and Hungary, as well as Ireland. And as well as having the grocery retail stores, there is Tesco Bank, there's Tesco Mobile, there's Booker, which is a convenience store, amongst others. So the business that we interface with as consumers living in the UK, that's not the full business. So a very sort of quick overview of what Tesco does and what its various business lines are. You can find that straight away here in the annual report. And if you look at the strategic report of the companies you guys are analysing, you'll be able to find similar information about the companies that you look at. And here, if we scroll down, it's got a bit more information about the various parts of the business. This is the core Tesco business. This is Booker, which is the wholesale outlets. You've got Tesco Bank and Tesco Mobile, amongst other businesses in there as well. And then it's got a little bit of information about, what their mission is. So most companies will have something in here about what they exist to do. So a healthcare company like AstraZeneca, which makes drugs, will have, helping alleviate cancer. For Tesco, their mission is quite simple, helping customers to spend less. And here they're talking about how they achieve that, their sort of key commitments to keeping prices low, etc. So just at the very outset, the first few pages of the annual report in the strategic report section, you've got some very, very helpful information. If you didn't know anything about Tesco, you could pick that up, read those first few pages, and you would have a reasonable understanding of what the Tesco business is, what the various moving parts are, and what they're trying to achieve. So that is a very, very key part of the first few pages of the strategic report. As well as that, the next bit I would draw your attention to is this section here, the Chief Executive's Review. So the Chief Executive Officer is ultimately the person who is running the business. So think of them as, if you guys go to school, the head teacher, right? So this person is responsible for the strategy of the business. If Tesco has stores in Ireland and they're not making money, this person's the person who will decide whether we keep our Irish stores or close them. This is the person that will decide, well, Tesco Mobile has been really good and Tesco Bank has been really good. Why don't we launch, Tesco Broadband or some other new product that they think might be attractive? So this person, the Chief Executive Officer, for Tesco, it is a chap called Ken Murphy. They write a report where they kind of set out what's been going on in the business. So this is a really helpful way to understand what the topical issues in the business are right now, how the last year has gone, and what the key issues facing the company in the next year are. So immediately you can see here, they're talking about supporting our customers with a relentless focus on values. They're talking about inflation is a pressing reality for everyone. We have price matched 600 items with Aldi. So it seems as if you were to read that document, the key issue that Tesco are kind of really talking about here is the cost of living crisis that you guys might have come across in the press. So they're talking about, inflation's gone up quite a lot. People are finding their money doesn't go quite as far. So how's Tesco kind of dealing with that? And then, there are some interesting bits that you'll find here. So you can see some commentary here about price increases they've had for eggs. So eggs have suddenly become quite expensive, and some information about a potato harvest. So whatever company you're looking at, if you read the chief executive's report, it's typically a couple of pages, but it'll give you a lot of information about what's been happening recently, what are the sort of key talking points about the business at present. So that is the second very useful bit of information that you can get from the strategic report section of the annual report. There's a couple more sections within the strategic report that I want to draw your attention to. One is the financial review. So this is down here in page 30. So if we have a look here, you'll notice the chief executives section was very wordy. It was, we're doing this, we're doing that. And words are a wonderful thing. You can say pretty much everything that you want, but I find, when you're analyzing companies, numbers are just as important, if not more important. And this is what tells you what the business has done. So at a glance, it's telling you that their sales were £65 billion. They've gone up by 7%. It's telling you they've made a profit of 1.5 billion. That's gone down by 40%. So that's not really good if your profit's going backwards. So although if you read the first half of the strategic report, everything seems to be going great, but this kind of tells you, well, we need to delve in a little bit further. Why is profit falling at this company? And this section tends to be really useful because what you'll find is they will break down the performance of the business by its different units. So you can see here what sales were made by the UK, by the Republic of Ireland, by Booker, by Tesco Bank, by their petrol operation, by their Central European operation. So this is very helpful if you've got a business that's got 4 or 5 different parts and you want to understand what each of those parts is doing. So we can see here for Tesco that the core sort of retail business has only grown 4.8%, but actually Tesco Bank's gone up quite a lot. It's gone up 20%. And the fuel part of the business, because petrol prices have increased, has gone up 23%. So the financial review section is quite useful in understanding beneath the headline number what's going on at the different parts of the business. And it tends to have quite helpful commentary. As you can see here, it's talking in more detail about what's going on in the UK and Republic of Ireland, and it'll have that information for each of the different parts of the business. So you can get a lot of understanding as well as a headline number, what the individual underlying parts of the business are doing. And the final section of the strategic report that I would maybe highlight, most companies will call it sort of sustainability. In here, they've kind of split out over a couple of areas called our colleagues and climate. So if we have a look at that. So this is, a lot of companies do what's called ESG, environmental, social, and governance. So as well as making a profit, companies feel they have to make a positive contribution to the environment, to the society they work in, and to the way the company is governed. So this is effectively where Tesco is covering off that bit of information. So they've got, it's a great place to work. Tesco hires 330,000 people across its footprint. So it's one of the biggest employers in the UK, and it's talking about how it's kind of investing in the colleagues, providing them with jobs and skills, making sure they're working in a safe environment. And the other bit here is climate. So like most companies, Tesco has targets in terms of reducing its CO2 emissions. So here it's talking about what their biggest sort of uses of energy are. So fridges, refrigeration is a huge part, heating, transport. So again, they're kind of talking about how they are planning to reduce the carbon intensity of those 3 activities, which make up a big part of their carbon footprint. So I appreciate that's a lot of information I've just thrown at you, but the key point to kind of take away from here is the strategic report is very, very good at finding out what the company does, what its sort of marketplace is like. So you can see there's another section here we didn't cover, our business model. I think that'd be quite an interesting one to look at. There's one here called our market context, our strategic priorities. So this is very helpful in terms of trying to figure out what the company does, what the market environment looks like, and that helps you build a picture of what are the prospects for this business. Is this a business that's going to grow or not? So that's very helpful information. The one thing I will say about this is a lot of this is information that's coming from the company themselves. So you just have to treat it with a little bit of pinch of salt. They're going to try and make themselves look as good as possible. So it's always the best slant on everything. Sorry about that. It's just something keeps popping up on my screen every now and again. The next bit of information is in the corporate governance section of the annual report. So that's the second section to look at. Now, this is effectively telling you how the company is being run. So the board of directors normally is independent of the management team. So it's people who don't actually work in Tesco. They come and sit down with the chief executive officer, with the chief financial officer, and the other people running the business, and they ask them, how are you guys running this business? What are the challenges? What are the opportunities? And they're effectively trying to keep the management team honest and make sure they are looking after the interests of the various stakeholders, which can be the employees or the shareholders. The one bit that I think is quite interesting here that you guys might want to look at is the director's remuneration report. So let's go to that. So the director's remuneration report is where the board sets out how the key directors are being paid. So it's quite interesting because what you can see here is, firstly, how much the directors are being paid. So Ken Murphy is the chief executive officer, Imran Nawaz is the chief financial officer. You can see how much they get paid every year. You can see what proportion of that is fixed. So that's the salary they get anyway. And then you can see the other bigger portion is performance pay. So they often have targets and they have to meet these targets in order to get this performance related pay. And if we look at Tesco, you can see over here, they've got some targets. Here we go, right? So they've got targets set in relation to a number of metrics. So one item is retail free cash flow, so how much cash the business is generating. One is adjusted diluted EPS, that means earnings per share. So if you take all the profits and divide them by the number of shares, that's earnings per share. So these two metrics between them represent about 75% of the performance related pay for the Tesco's executive directors. This is very important. So they're being motivated to grow the company's free cash flow and the earnings per share. And then they're also being motivated by these ESG measures, so environmental, social, and governance, which are around reducing carbon usage, reducing food waste, and improving diversity and inclusion in the business. So if you know what's incentivizing these people, you kind of know what they're aiming for. So again, it's very, very helpful to know what's motivating the management team, and having a read of the director's remuneration report can help you get a picture of that. The third section of the annual report is called the financial statements. Now, this is probably the most important segment because, as I said, the bits up here, the strategic report and the corporate governance report, you can kind of write whatever you want to here. There's really no set, there's no set rules. There are some sort of common practices, but you can write whatever you want. In the financial statements, there are a set of rules called accounting standards, and every company has to follow those accounting standards to produce their financial statements. And somebody else independent of the company, an auditor, will come in and check those financial statements to make sure they actually comply with the accounting rules. So you've got somebody actually checking the numbers that the company is putting out, so we know that these numbers are somewhat reliable. So this is the only part of the annual report that gets checked by somebody independently, and that has to comply with these rules. So it's very, very important. And let's have a quick look at that. There's probably two parts to talk you guys through. The first part is the independent auditor's report. So the auditors are a separate firm who are paid money to go and look at these accounts to make sure they're not telling lies, effectively, right? That these accounts are in accordance with the accounting standards, and they provide a true and fair view of the company. You can have a read here, but the key thing is you want to look at the opinions. So in here, it's saying that the group's financial statements have been properly prepared in accordance with the United Kingdom adopted international accounting standards. They're in accordance with the Companies Act, etc., etc. So basically, you want to read that to make sure the accountants have signed off the report and said the accounts are okay. The other interesting bit here is you can look at these key audit matters if you want to. That will basically tell you the bits that the auditor thinks is important. So often that can flag some risks within the business. So for Tesco, they think store impairment review is quite important. So Tesco owns and leases the stores it has, and those stores have a value. So when you do an impairment review, you make sure that the value of the stores is appropriate. It's not too high or it's not too low. So clearly the auditors think the value of the stores is quite important for Tesco. The other areas could be sort of here, they've got Tesco Bank loan impairments. So Tesco Banks makes loans to people. They make mortgages and credit card loans. And obviously the value of those loans is very important. If people can't pay back their mortgages, or if people can't pay back those credit card loans, then Tesco makes quite big losses. And you wouldn't think it that a supermarket would have to worry about people paying back their mortgages, but because Tesco owns a small bank, it has to think about those things as well. So it's very helpful just to have a quick glance to see what the key audit matters are. You might find some useful information in there. And then underneath the auditor's report, you guys will come across the actual financial statements themselves. So there are three very important parts to the financial statements. One is the income statement, secondly is the balance sheet, and thirdly is the statement of cash flow. And I'll talk you briefly through each of those. So the income statement is talking about the last year that's just ended. So for Tesco, this is the 52 weeks that have ended on the 25th of January 2023. So in the last year, how much revenue has the company generated, how much profit or loss it's generated, and how much tax is paid, etc. So if you look at Tesco, they have generated 65.7 billion pounds of revenue. It's a very big number, and that has gone up from 61 billion in the last year. So that's quite nice as a shareholder of Tesco to see that. But you can also see the line underneath that is cost of sales. So all the stuff that Tesco is selling us in their supermarket, they buy in from farmers and other companies that make, detergents or beverages. So all of that stuff costs them 65 billion pounds to make. That leaves them with a gross profit. So if the revenue they've generated minus the cost of all the stuff that they bought of 4.7 billion, that's a 7% gross profit margin. That's actually quite low. So out of every £100 of stuff that Tesco sells, only 7% is left over to pay the staff and pay all the bills and make a profit from. If you compare that to other businesses, so Microsoft, we're using Microsoft Teams right now, that has a gross margin of 70%. So they keep £70 out of every 100 to pay for people's wages, etc. If you look at some luxury good brands like Louis Vuitton, they also keep 70% of the revenue as gross margin. So Tesco's a very low margin business. Normally, low margins tend to be quite bad. You want businesses with higher margins. Then, so they've got this 4.7 billion pounds of gross profit. Then they have administrative expenses of 2 billion pounds. So this will be paying for the staff, their head office staff salary. This will be paying for heating and lighting, paying for the rent on their stores, etc., etc. So once you've taken that out, they're left with only 2.6 billion pounds of profit. So that is operating profit margin of 4%. Again, if you compare that with Microsoft, Microsoft makes a 40% margin. So Microsoft's a very profitable business. Tesco has very, very thin profitability. It's not a terribly profitable business. Underneath that, they've got finance costs. So this is paying for their loans and other sort of borrowings. So when you take that away, they're left with 2 billion. Then they're paying tax of 400 million. And finally, as shareholders, you guys are left over with this number here, which is the profit for the year for the shareholders, which is 1.6 billion. So we started off by making sales of 65 billion, and we're left with 1.6. So not a highly profitable business in that respect. So when you look at your companies, I think you guys have been asked to pull together the last 5 years of financial information, revenue, operating profit, also known as EBIT, and profit before tax. If you find the last 5 years of annual reports, you'll be able to get that information from there. The other couple of bits of information that are useful here in the financial statements are the balance sheet. So the balance sheet is different to the income statement. The income statement tells you how much profit or loss or revenue you made in a given year. The balance sheet, think of it more like your bank account. So it's telling you all the things that you own, which are your assets, and all the things that you owe other people, which are your liabilities. So for Tesco, their big assets are their property, plant, and equipment, which is their stores effectively. They've got loans and advances to customers. These are the loans they've made to customers in the bank. And they've got cash. They've got £2.5 billion of cash. Their big liabilities are trade and other payables. So Tesco buys things from its suppliers, so farmers or companies that make ice cream, for example, right? And they owe those companies £9 billion. They have borrowings at the bank, £5.8 billion. They have lease liabilities. This is the money they have to pay on rent. So when you take the assets away from the liabilities, what you're left over with is equity. This is what the money that belongs to shareholders, effectively, which is £12 billion for Tesco. One very important number, which is not on the balance sheet, and you guys might want to write this down, is called net debt. So if you take the cash a business has, so Tesco has £2.5 billion of cash, and the borrowings that a business has, Tesco has 1.7 billion of current and 5.5 billion of non-current liabilities. The cash minus the borrowings is net debt. That's a very important number because that's what the stock market looks at in terms of deciding how much debt the business has. Too much debt can be a really, really bad thing for a business. So normally the number that we look at is anything above 2.5 or 3 times. So if you take your net debt number and you divide it by another number called EBITDA, which is earnings before interest, tax, depreciation, and amortization, if you control F in the annual statement, you'll be able to find EBITDA somewhere. If the ratio of net debt to EBITDA is more than 2.5 times, normally people think the business is highly indebted, and that can be quite risky. Now, if your business is a stable business, so let's say a healthcare company like AstraZeneca, which makes drugs, or a utility company like Scottish Power or British Gas, or indeed a grocery store company like Tesco, their business is very stable. People go to Tesco all the time. We're all going to pay our electricity bill. If people get ill, we all buy drugs. Those businesses can generally afford higher debt. They can afford debt at 2.5 or 3 times. Businesses which have more variable earnings, say a company making cars, because if a recession happens, chances are I'm not going to buy a car. Or a company selling kitchens, again, if a recession happens, I lose my job, I'm not going to buy a new kitchen. For those businesses, we don't like to see debt at all. So a very important number is net debt. It's not on the balance sheet, but you can search for it and find that out. And the third area you want to look at is the cash flow statement. So this shows you profits are one thing, but cash is another thing. And this shows you how the profits of the business. So you start off here with £1.5 billion of operating profits. How are those profits turned into cash? So for Tesco, they start off with £1.5 billion of profit, and their net cash generated from operating activities is 3.7 billion. So they're actually making more cash than profit. And one of the reasons is depreciation and amortization. So they've bought assets in the past that cost them a lot of money. They've already paid the cash for it, but because of accounting rules, you depreciate them over time. So it's a non-cash cost. So actually, Tesco generates more cash than profit because of depreciation. So this is also quite a useful thing to look at, how much cash is being used in the operations of the business. So I appreciate that's a lot of information coming at you guys. Those are probably the 3 sort of key areas in the financial statements that you want to look at. So to briefly summarize that whirlwind of information, you've got 3 sections to the annual report: the strategic report, corporate governance, and financial statements. The strategic report has lots of very helpful information about what the company does, what its business model is, what its challenges are, etc., etc. The corporate governance report tells you about how the company is being run, and within here, the director's remuneration report is quite interesting because it tells you how the directors are being incentivized to run the business. And finally, in the financial statements, the most interesting things are the income statement, which tells you in that year how much profit or loss that company has made, how profitable that company is, the balance sheet, which tells you how much cash a business has, how much debt the business has, and finally, the statement of cash flow, which tells you how the company is turning profits into cash flow because it needs cash to be able to pay for everything, from staff costs to rent, etc., etc. So again, I appreciate that's a lot of information for you guys to digest, but hopefully that's a very helpful overview of the key bits of information that you can look at in an annual report to find out what you need as part of your entry in the future asset competition. And hopefully it makes the task of navigating the 200 pages a little bit simpler. Before I hand you back to Helen, I'd just like to kind of point out a couple of things here. Firstly, every company's annual report is slightly different, but they should follow this common format of strategic report, corporate governance, and financial statements. Secondly, this financial statements bit, this is the only bit that is in accordance with accounting rules and is checked by auditors. The rest of this, a company can write what they want. And management teams often put in the good news. So they'll talk about, we've been fantastic, we've been great, and they'll leave out the more difficult stuff. So you shouldn't rely on the annual report alone. You should also look at news reports, and Google searches are very helpful to find out what's going on with the company. But basically, the annual report, think of it as, the management want to make themselves look good. It's like you guys, being able to write your own report card at the end of the year. You'll put in the good stuff, you'll leave out the bad stuff, right? That's what the management teams are doing. And the final thing I'd maybe point you towards is results presentations. So as well as annual reports, companies release these presentation packs, which are a very sort of high level overview of what's gone on in the year. So rather than having 200 pages of lots of lines, this will just give you a very brief overview of what the business is doing. So again, it's telling you they're focusing on customer satisfaction. They're talking about their market share, that Tesco's market share has gone up, but the other guys' market share has gone down. They're talking about inflation. They're talking about helping customers to spend less, how they're helping to pay their colleagues more money. They're supporting farmers, etc., etc. So you can see it's got a lot of information. A lot of it is, making themselves look good. But again, if you didn't know anything about Tesco, you could read this and find out a lot of very helpful information. And it's also got some financial information as well about the different sections that can help you find out a bit more about Tesco. But the key caveat here is there are very little rules that apply here, and the company will put in the best bits of information that it can within the presentation. So if you thought the annual reports have some sections that you need to treat with a pinch of salt, that applies doubly so over here. With that, I'll just hand back to Helen. Thank you.
Thank you very much, Sajir. Could you actually go back to that last presentation slide? Because when you said that Tesco compared themselves with Sainsbury's and Morrison's and Asda to show that they had, I think those were the three, to show they had a greater share. They didn't compare themselves. Am I right? Did they not compare themselves with Aldi and Lidl? There we go.
Absolutely. So if you were to put in Aldi and Lidl are the ones that are gaining market share from everybody else. So basically what Tesco are saying is ignore Aldi and Lidl, and well, compared to the guys that we used to compete with, so before Aldi and Lidl came to the UK, it was Sainsbury's, Asda, Morrison and Tesco were the best of this lot. But are they just saying, are they the best of a bad bunch? Because if you included Aldi and Lidl, their market shares would be going up a lot more.
Exactly. And that was exactly your point about they present the information that they want to present, and so it doesn't necessarily give you the whole picture. So I think that's kind of like just a really useful example of that. That was incredibly useful. Thank you very much.